Picture this. It's January 31st. You've just missed the self-assessment deadline. HMRC sends you a letter. £100 penalty immediately. Then another £100 after 3 months. Then daily penalties of £10 per day for up to 90 days. Here's the brutal truth. Over 1.2 million UK taxpayers miss the self-assessment deadline every year. That's £120 million in penalties. Money that could have been saved with proper planning. But penalties are just the start. If you're paying more tax than you need to because you don't understand what you can claim, you could be losing £2,000, £5,000 per year legally. Here's the good news. Self-assessment isn't complicated once you understand the system. The rules are clear, the deductions are generous, and with proper planning, you can legally minimize your tax bill. In the next 13 minutes, I'm going to show you exactly how UK self-assessment works, who needs to file, what you can claim, the step-by-step process, and the 5 biggest mistakes that cost UK taxpayers thousands. Let's get into it. All right, so what exactly is self-assessment? In simple terms, self-assessment is the UK tax system where you tell HMRC how much you earned and how much tax you owe. It's your responsibility to calculate and pay the right amount. Who needs to file self-assessment? You must file if you're self-employed and earned more than £1,000 in the tax year April 6th to April 5th. You're a partner in a business partnership. Your income is £100,000 or more. You have untaxed income, rental income, dividends, interest over certain thresholds. You're a company director. You have capital gains over your annual allowance, £3,000 in 2026. You need to prove your income for things like mortgage applications or child benefit. The tax year runs from April 6th to April 5th. So for 2026, you're filing for the tax year April 6th, 2025 to April 5th, 2026. Key deadlines: October 31st paper returns, January 31st online returns. Dis ESE BHE Big A U January 31st payment due. Miss January 31st and the penalties start immediately. Now let's talk about what you can actually claim to reduce your tax bill. Here's where most people leave money on the table. Legitimate business expenses. If you're self-employed or have rental income, you can deduct office and administrative costs, stationery, postage, phone bills, software subscriptions, accounting software, design tools, website hosting and domain names, professional subscriptions and trade magazines. Travel expenses, mileage for business, travel 45p per mile for first 10,000 miles. Train, bus, taxi fares for business trips. Hotel costs for overnight business stays. Not your normal commute from home to your regular workplace. Use of home as office. Simplified expenses, £6 per week if you work from home regularly. OR actual costs, proportion of rent, mortgage interest, council tax, utilities based on business use. You can't claim for a whole room unless it's exclusively for business. Clothing expenses, now uniforms required for work. Protective clothing, PPE, safety boots, costumes for performers, not normal business attire suits, smart clothes you could wear elsewhere. Staff costs, now salaries and wages, employer NICs and pension contributions, staff training and development. Staff entertainment capped at £150 per head per year for annual events. For rental property landlords, you can also deduct letting agent fees, maintenance and repairs, not improvements. That's a different rule. Insurance buildings, contents, landlord liability, utility bills while property is vacant, council tax while property is vacant, legal fees for lets of a year or less, accountancy fees for rental accounts. But here's the big one most people miss. Capital allowances for equipment. If you buy equipment for your business, laptops, cameras, machinery, office furniture, you can claim the full cost as a deduction in the year you buy it through something called the Annual Investment Allowance AIA. The AIA limit is £1 million per year for most businesses. So if you buy a £2,000 laptop for your freelance work, that's £2,000 off your taxable profit. At 40% tax rate, that saves you £800 in tax. Now let's talk about the process of actually filling in your tax return. All right, so how do you actually fill in your self-assessment tax return? Here's the step-by-step process. Step 1. Register for self-assessment. If you haven't already, register at gov.uk/self-assessment. You'll get a unique taxpayer reference UTR within 10 days post or immediately online. You also need to activate your government gateway account if you don't have one. This is your login for all HMRC online services. Step 2. Gather your records. Before you start filling in the form, gather all invoices and receipts for income. All receipts for business expenses as bank statements showing business transactions, details of any other income dividends, interest, rental income, records of any capital gains property sales, share sales, details of pension contributions, gift aid donation receipts, childcare cost records if claiming tax-free childcare. Step 3. Choose your method. You have 3 options. Option A. Fill in the online form yourself. Free, takes 2 to 4 hours for straightforward returns. Gov.uk has guidance for each section. Good for simple, self-employed or rental income. Option B. Use accounting software. Costs £5, £30 per month. Automatically calculates your tax. Connects to your bank accounts. Examples: Free Agent, Xero, QuickBooks, Free Tax. Good for ongoing record keeping. Option C. Hire an accountant at costs £200, £500 per year for simple returns. £500, £1,000 plus for complex situations. They handle everything and ensure compliance. Good if your situation is complex or you don't have time. For most people with straightforward self-employment or rental income, I recommend option B, accounting software. The time savings and accuracy are worth the monthly cost. Step 4. Fill in the relevant sections. The tax return has different sections depending on your income. SA100. Main return personal details, employment income, pensions, SA103. Self-employment income and expenses, SA105. Rental income and expenses, SA108. Capital gains, SA106. Foreign income. You only fill in the sections that apply to you. Step 5. Calculate your tax. HMRC software calculates your tax automatically if you use the online form. But here's how it works. Income tax bands 2026, personal allowance, £12,570 tax-free basic rate, 20% on £12,571 to £50,270. Higher rate, 40% on £50,271 to £125,140. Additional rate, 45% above £125,140. Note: your personal allowance reduces by £1 for every £2 earned over £100,000. So if you earn £125,000, your personal allowance is 0. Step 6. Submit and pay. Submit your return online by January 31st. You can pay your tax bill, direct debit, one-off or installments, debit/credit card online, bank transfer, at a post office with payslip. If your bill is over £3,000, you can opt to pay in 2 installments, 50% by January 31st, 50% by July 31st. Now let's talk about the mistakes that cost people thousands. Right. The 5 biggest self-assessment mistakes that cost UK taxpayers thousands every year. Mistake number 1. Missing the deadline. I mentioned this in the hook, but it bears repeating. January 31st is non-negotiable. Penalties. 1 day late, £100 fixed penalty. 3 months late, £10 per day for up to 90 days, £900 maximum. 6 months late, 5% of tax owed or £300, whichever is greater. 12 months late, another 5% or £300. And HMRC charges interest on late payments at 7% per year as of 2026. Set a calendar reminder for January 20th. Give yourself 10 days buffer. Mistake number 2. Not claiming all legitimate expenses. Most self-employed people underclaim expenses by 3050% because they don't know what they can claim or they're afraid of being audited. Here's the truth. HMRC expects you to claim legitimate business expenses. Not claiming them doesn't make you look honest. It makes you look like you don't understand the rules. Common missed expenses, home office costs, even £6/week, adds up to £312/year. Business mileage 45p/mile. A 100-mile business trip =£45 deduction. Professional subscriptions, trade bodies, professional indemnity insurance, training and education courses that maintain or improve your skills, business entertainment, client meals. Though rules are complex, keep detailed records and claim everything you're entitled to. Mistake number 3. Mixing personal and business finances. If you're using one bank account for everything, you're making your life unnecessarily difficult. Open a separate business bank account. Even a free one like Starling Business or Monzo Business makes record-keeping 10x easier. When expenses are mixed, you either underclaim losing money, overclaim risking an HMRC investigation. Neither is good. Mistake number 4. Not keeping proper records. HMRC can investigate your tax return up to 6 years after the filing deadline if they suspect deliberate errors. That means you need to keep records until at least January 31st, 2032 for the 2026 tax return. What records to keep? HAL invoices, sales and purchases, all receipts for expenses in bank statements. Mileage logs date, destination, business purpose, miles or records of home office use if claiming actual costs, asset purchases for capital allowances. Use cloud accounting software to back everything up automatically. Paper receipts fade, get lost, and are a nightmare to organize. Mistake number 5. Not paying on account. Here's something that catches new self-employed people off guard. Payments on account. If your tax bill is over £1,000 and less than 80% of your tax is deducted at source through payee, HMRC will ask you to make advance payments toward next year's tax bill. These are called payments on account, 50% due by January 31st with your current year tax bill, 50% due by July 31st. So if your 2025 tax bill is £10,000, you pay £10,000 by January 31st, 2026-2025 tax, £5,000 by January 31st, 2026 payment on account, £5,000 by July 31st, 2026 payment on account. That's £20,000 in 1 year for a £10,000 tax bill. It's a massive cash flow shock if you're not prepared. You can apply to reduce payments on account if you know your income will be lower next year, but HMRC will charge interest if you reduce them too much. Avoid these 5 mistakes and you'll be ahead of most UK taxpayers. All right, now for the good stuff. Legal strategies to minimize your tax bill. Strategy 1. Use your personal allowance fully. Everyone gets £12,570 tax-free. If you're married or in a civil partnership and one of you earns under £12,570, you can transfer £1,260 of their personal allowance to the higher earner through marriage allowance. That saves £252 per year in tax. Strategy 2. Maximize pension contributions. Pension contributions are tax deductible. If you're a higher rate taxpayer 40%, every £100 you put into a pension saves you £40 in tax. You can contribute up to £60,000 per year or 100% of your income if less and get tax relief. This is one of the most powerful tax planning tools available. Strategy 3. Use your ISA allowance. While ISA contributions don't reduce your income tax, all investment growth and withdrawals are tax-free. So if you're building wealth, max out your £20,000 ISA allowance every year to avoid future capital gains and dividend taxes. Strategy 4. Time your expenses. If you're close to the end of the tax year April 5th and you know you'll have a large tax bill, consider bringing forward business expenses you'd normally incur in the new tax year. For example, if you need new equipment in May, buy it in March instead. The deduction counts against this year's income, reducing your current tax bill. Strategy 5. Use the trading allowance. If your self-employment income is under £1,000 per year, you don't need to report it or pay tax on it. This is the trading allowance. If your income is between £1,000 and £12,570, you can choose to use the £1,000 allowance instead of claiming actual expenses, whichever gives you the bigger deduction. Strategy 6. Consider incorporating. If you're earning over £50,000, £60,000 as a sole trader, consider setting up a limited company. You'll pay corporation tax 1925% instead of income tax 4045%, and you can extract profits as dividends, lower tax rates and salary using personal allowance. This is complex and requires professional advice, but the tax savings can be £5,000, £15,000 per year for higher earners. These strategies are all legal and HMRC compliant. The key is planning ahead, not scrambling in January. Now, let's talk about what happens if you make a mistake or need to amend your return. Here's the thing. Mistakes happen. You file your tax return, then realize you forgot to include income, or claimed an expense incorrectly. You can amend your tax return within 12 months of the filing deadline. So for the 2026 tax return filed by January 31st, 2026, you have until January 31st, 2027 to make changes. To amend, log into your HMRC online account. Go to your tax return, select Amend Return, make the corrections, submit the amended return. If you owe more tax, you'll get a new payment deadline. If you've overpaid, HMRC will refund you usually within 5-10 working days. If HMRC investigates your return and finds errors, the penalties depend on whether the error was careless, 0 to 30% of extra tax owed, deliberate, 20, 70% of extra tax owed, deliberate and concealed, 30, 100% of extra tax owed. If you voluntarily disclose errors before HMRC finds them, penalties are reduced by 2050%. So if you realize you've made a mistake, come clean sooner rather than later. Now let's wrap up with your action plan. Right, so here's your action plan to master self-assessment and minimize your tax bill legally. Step 1. Register for self-assessment now. Don't wait until January. Register today at gov.uk. It takes 10 minutes and you'll get your UTR within days. Step 2. Open a separate business bank account. If you're self-employed or have rental income, separate your finances today. Starling Business, Monzo Business, or even a basic Barclays business account. All free or low cost. Step 3. Choose accounting software. Sign up for Free Agent, Xero, QuickBooks, or Free Tax. Connect your bank accounts. Start tracking income and expenses from day 1. Most offer 30-day free trials. Step 4. Set calendar reminders. Set reminders for October 15th. Start preparing your tax return January 20th. Final deadline reminder January 31st. Submission and payment deadline. Set monthly reminders to reconcile your accounts and claim expenses. Step 5. Maximize your tax planning. Review the strategies I showed you: pension contributions, ISA allowance, expense timing. A marriage allowance, if applicable, to consider incorporating if earning £60,000 plus. Step 6. Keep records meticulously. Digital receipts, mileage logs, bank statements. Back everything up in the cloud. Make it a weekly habit, not a January panic. If you follow this plan, self-assessment becomes a manageable 2-hour task in January, not a stressful nightmare. And more importantly, you'll keep more of your money legally. If this video helped you, please subscribe. Every week I'm putting out videos exactly like this one. UK-specific money advice that actually works. Hit the bell too, so you don't miss the next one. And when you're ready, this video right here about credit scores is a great next watch. Because if you're self-employed and applying for mortgages or loans, your credit score is critical. Thanks so much for watching. I'll see you in the next one.